Welcome to TradeTheMBI.com. This is John. This report is for the 13th. It's not a Friday, but you can see right now we're in the midst of a teeny bit of a pullback within the previous day's range, and coming off the exuberance that really propelled things when there was the expectation the hurricane wasn't going to be as catastrophic. I mean, it's still pretty horrible if you see some of the imagery coming from the Keys, but the things will get turned around and moving forward again, and that we've eliminated some of the existential threats of budget deal, blah, 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 and the list goes on. It doesn't mean that, there's pie in the sky, but it does reflect the fact that there's a growing economy at this particular point, and with that, there's going to be some benefits. You couple it with increased euro, low oil costs, and the potential is there if you get some kind of tax relief moving along, then realistically we're still way short of what the multiple will probably end up being, which definitely, if something like this were to take place, you're definitely going to push the ES over 3,000. You're definitely going to be getting near 7,000 here on the NQ, which has been a little bit more modest. You can see the difference between the ES breaking all the way up to there, the NQ just a little bit shy of that. Apple was doing its layout for the next iPhone, blah, 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 blah. But that tends to have its impact a little bit later on after the release of those items, when people really start to see the sales effect of them. And the euro, maintaining its lofty altitude here, is definitely going to keep the ES mitigated from any kind of major beatdown. And the money, well, yeah, all the people who were in this ridiculous trade of treasuries seeing it come down, because the reality is there's no other way but for rates to rise. It's going to be an interesting one for them, how they're going to function. I mean, the 20 trillion in debt. There are a lot of other issues that relate to people and their need to go into treasuries for safety purposes and stuff, but there's no yield there, and this is another factor. All the money that comes in can't really go there because you need to get a return, and that is going to keep pushing equity prices to what people are going to call a bubble. But if you think of it in terms of just a different expectation as far as the market multiple, then you recognize that it's really not that overdone, and that's something you're going to have to keep in mind, and it's a tough one for people to come to grips with, simply because it's not what they're used to from the recent past, but from a historical standpoint, we're not at the peak. And oil, right there, back in the middle of the range, and this is what I was talking about, that we were just going to stay in this band, and that's not going to change at this particular point. We've been in a little bit of a short run from earlier, but we've got a complete reset of short-term buyers who are lifting a little bit, seeing the massive drawdown in gasoline. Most of that's because of hurricane. When everyone has to fill up a tank of gas, you're really going to quickly draw everything down. The real question is going to be how soon will the capacity be restored in Texas and that to really determine whether or not supply is going to be impacted, and how much growth is going to be impacted. The question was, were we going to see a significant GDP reduction simply because of the hurricanes and loss of labor? So that's yet to be determined, but some were saying it could be as much as 0.5%. That's a lot, particularly with the momentum that was going. And so whether that gets stalled or not, I think it's a little tough. You're not going to know till the end of the year on that one, because this is sort of going to interrupt the data. Gold, again, plenty of positive extremes that needed to be refilled off of the short that came up here. And once you had the cross of the steel below, that was your first warning signal that things were going. And then complete reset. I mean, you just had no short-term buyers into it at all, simply because it didn't look like there was going to be any pressures for inflation in that. But again, this is going to be on a continual up arc over the course of time, simply because at a certain point there is going to be the change from the money that's been let out for QE from a digital standpoint into a physical realm, and as that starts to happen, inflation is going to get pushed, and this is the desperate need for new, cheaper labor, as well as maintaining low oil costs and that. And it looks like the oil situation is going to be under control. The real question is going to become labor, and if you continue to tighten the supply of labor, and or with this opiate crisis, and we're seeing that so many otherwise able working Americans are unhireable due to drug use and that. It's a real question mark as to what's going to happen with growth, because if you can't find new people, it's going to create a bottleneck that will stagnate things or force wages to go up exponentially, which that is the bigger driver of inflation than anything. So we can see here we had the DOC spread on the 5K chart. Happened very late. There were some early moves right in here where we were flirting with going below, and pretty much was just holding its own. And then finally we ended up with a point where the steel had crossed for the last little buy run, and then when it came back below, and the steel dips below the cyan right there. At the same time, the next bar you end up getting a DOC spread, which took place just right after, and that's when you saw our first decline of any sense. But geez, we've got positive extremes going all the way back. Right through here would be typically the expectation about an 85, which I would expect to be right around a support line, because that's what we were looking at for being above to push to the 2,500 level. Came very close to it in that after hours. What was the full peak high? 24.9550, so 4.5 points shy of it. It's been a significant wait, but the expectation for getting there hasn't changed, and I think that we're still on course for it. It's just going to take a little bit of back and forth, and once it breaks through it, I think you're going to see a lot of money have to chase it, because again, you have plenty of funds in that must match the S&P returns, and so that's going to take a little bit of a toll. So we'll keep an eye on that. Continuing to work with the broader program. I know I showed the 50K chart before, and the adjustments that I'm working with the ABM. I'm hoping to have those out. Actually, this is the one that has the strategy actually going from right here. We can see new stops coming in, 24.88 range, on closes below that point, which is not bad considering the entry was right there at 24.53. Nothing wrong with 50 points on those moves. And the daily we saw also it bought from the earlier level. So it's all in line with our expectations, which really go counter to what I see so much in a lot of articles in that, but that's always the case. Conventional wisdom usually gets the trade against it, and they end up on the wrong side of things. But as always, though, do you look for me on the Skype chat? Trade well.